Many of my clients navigating their retirement futures are torn between riding current market highs and not being overexposed when the next market downturn hits. I'm Dustin Rudolph, founder and president of Legacy Ascent Wealth. In today's episode of Summit Ascent Retirement, we're going to discuss our strategic portfolio approach, a key pillar into how we help our clients optimize their income and performance to create meaningful memories and to live their legacies. In retirement, how do you strategically invest in a market that's consistently going up? What if there's an AI correction similar to the magnitude that we saw with internet stocks at the turn of the century? Some clients I meet with have recency bias, meaning if the market's been up the last few years, that's the way the market's going to behave in the future. Other clients are so afraid to even sneeze with the fear that the markets are going to implode. In our last episode, we discussed why investing during the income phase of retirement is so much different than investing during the accumulation phase during retirement due to sequencing of returns risk. So before getting into the strategic portfolio approach, I wanted to show you why investing during the income phase of retirement is so much different than investing during the accumulation phase. Over on the right-hand side, I brought back an example from our first episode looking at returns from a 60-40 portfolio from 2000 to 2024, utilizing the aggregate bond index and the S&P 500 in a 60-40 portfolio, adjusting for inflation of 2.4%. So starting off in 2000, we have a negative return, 2001 negative return, 2002 negative return. The market recovers. We get to 2008, the global financial crisis. Market recovers till 2022. And at the end of the day, we have $4.2 million inflation adjusted. If we flip those returns upside down, so starting with 2024 and the 15% return, then the 18% return from 2023, go backwards, and with 3 down years in a row, we end up with the same $4.2 million. What's going on? During the accumulation phase, the returns are all that matters. It doesn't matter which order they're in. It's just fueling the portfolio for growth. All else being equal, no matter how many different ways you reorder this, you're going to get the same ending result. However, when you're taking income, that simply isn't true. So let's take a look at what happens if we're taking $60,000 per year or 4% from our $1.5 million portfolio. Well, in the light blue line, our $1.5 million drops to almost $1 million after 3 years. That can be pretty scary for a retiree thinking, how is this going to last for 20, 30, 40 years? Well, with the market, it levels off. We get to the global financial crisis, hit another drop again, and at the end of 25 years, we're left with just under $900,000. In the scenario that we looked at the last time, when we weren't taking income off of it, we ended up with the same $4.2 million. Well, because those returns happened at the beginning of our retirement, our portfolio went from $1.5 million, nearly up to $2 million, all the way up to $3 million at one point, in leveling off back down around $2 million. So in one case, you have $2 million, and in another case, we have less than $900,000. Same returns, different orders, completely different experience. So why is this happening? When you're taking income, you're locking in your losses. And the larger the losses that we lock in at the beginning, the more detrimental it's going to be on your portfolio. So let's take a look at the graph. We have worst case scenario. That's when our worst year happens our first year retirement, our second worst year happens the second year of retirement, so on and so forth. In this scenario of the same 25 returns, our income runs out after the 11th year. Best case is we get the highest returns at the start of retirement. So in the pink line here, we start off with our best year, then our second best year, and then we end off in our last year with our very worst year, so 2008. One example, $3 million at the end of 25 years, worst case, run out of money after the 11th year. Over one 25-year period, there are over a septillion different outcomes from just the returns of 2000 to 2024. Now, when you think about the range of markets that can happen over your retirement, there is an infinite amount of outcomes. That is why it's so incredibly important to structure your assets with a purpose. And next, we're going to show you how you can do that. Income models like the 4% rule ultimately are trying to figure out how much income you can take from your portfolio without running out of money. And the key components of any income model, besides how much money you have in your portfolio when you start drawing from it, are what are the expected returns and how much volatility are you taking in order to get those expected returns. All else being equal, the higher the returns, the higher the income, and the higher the volatility, the lower the income. So you have these two key components working against each other. And why is that? We'll take a look at the bell curve here. In a portfolio with an expected return of 6% per year, you can take a look at this white line. Well, with the variance of 12%, 7 out of 10 years, you're going to get returns between negative 6% and positive 18%. 19 out of 20 years, you're going to get returns between negative 18% and positive 30%. So you have to account for these years where you're locking in these negative returns, as we saw in 2008, 2022. If you're starting there, your portfolio value is going to go down significantly. And so what we want to do is have the returns and the volatility work for you. So how do we accomplish getting returns to work for us and volatility to work for us the same way as it did during accumulation years? The way that we do that is structuring your portfolio strategically by having assets that are focused on growth and assets that are focused on income. So our assets that are focused on growth, we can take higher volatility to earn higher returns. And within those assets, those are ones that we are putting away that we don't need to touch for 5, 6, 7, 8 years. Meaning that if we have a recession, financial crisis, we're not touching those assets because we have this other bucket over here that we're drawing income off of. However, when we do have great years in the market, we're locking in those gains and we're feeding them into
Building a retirement plan is like
assets.
building a new house. You need a blueprint that tells you the parameters that you're working with. And in retirement, that's your assets and liabilities. Your income target is like your square footage. Once we know that, we can build the rest of your home where each level has a purpose based on its function. Just like a retirement plan where each asset has a purpose, which is our strategic portfolio approach we're going to get into next. The foundation for any retirement plan is your income stream. So we're going to fill in as much of the foundation with our Social Security, pension, annuities, whatever predictable income we have coming in. And then the delta between what we want and what we already have is where we're going to position assets to fill in that income gap. Going up to the first level, our first level is funds that we need that we can get in and out of quickly. So in retirement, that is your emergency funds. It's your pending big ticket expenses, travel, whatever it may be. those big things that you may need money for in the first 3 to 5 years. When we go into the second level, that's where we're putting away assets to replenish our lower levels, and they're entirely focused on growth. And getting into our attic, those are assets that we don't need for 10 plus years down the line. That might be long-term care, inheritance. It might be legacy goals that you may have, but we don't need that for 10 plus years. And it can also be used to replenish the lower levels, just like the second floor. It all drifts downwards. Now that you've seen the purpose of each level, let's see how we account and how we invest within each level. So in our foundation, we have our Social Security, we have our pensions, we have our rental income, our annuity income, dividends from bonds, you name it. The assets that we put aside to fill in whatever that gap may be, we want them in low to no volatility type investments. This could be cash, cash equivalents, money markets, stable value funds, income instruments, anything that we can take monies out of that's earning us some sort of return without locking in significant losses. On our first floor, these are the monies that we need access to within 3 to 5 years. Again, we want low volatility type assets and investment instruments. So high quality bonds, cash and cash equivalents, fixed income, you name it. So on these first two levels, the key is not having volatile funds so that you're not locking in significant losses, because this is where we are taking your income from. We are not taking income from the top two floors. In the second floor, we're investing in moderate to high volatility so we can generate significant returns that can fuel your portfolio for living another 30, 40 years. This might be real estate, U.S. large cap, diversified funds, whatever it may be, depending on your risk tolerance and your portfolio targets. In our attic, that's where we're putting our most volatile assets. Could be emerging markets, could be high growth focused. For some people, it's going to be the diversified portfolio, strictly based off of what your risk tolerance is and what we want the portfolio to accomplish. But as you can see, we have purpose for each and every one of our investments, whether it's drawing income off of, having in and out access, or being set aside long term to lock in gains when they come into the portfolio, and then filter those gains down into our income assets. So what could this look like in a portfolio? Well, to keep it apples to apples to our earlier example of putting $1.5 million into a diversified portfolio of the S&P 500 total returns, as well as the aggregate bond index, I wanted to use similar assets to show you the overall value on what impact this has to your portfolio during retirement. So in the income foundation, we're setting aside $300,000 in cash equivalents, earning 4.25% interest per year. In our first level, we're putting away $150,000 because that's what we will need access to within 3 to 5 years, including our emergency funds. In our growth, we're putting away $560,000 in a 60-40 diversified portfolio. So that same S&P 500 total returns plus the aggregate bond index, which is what the high quality bonds are. And then the 10 plus years, we're just doing S&P 500 total returns. In future episodes, we can take a look at why you can take on more risk because you're limiting the volatility in income. But for this example, let's take a look at what that actually means for your portfolio. So now that we've built our retirement plan, let's take a look at what this would have meant for a retiree's portfolio based on the previous example that we gave, taking $60,000 out per year from our $1.5 million portfolio. As you can see here, we have our growth assets, and this is our top two floors. So our diversified 60/40 portfolio of the S&P 500 and the aggregate bond index, along with 100% of the S&P 500 for our attic. We have our short-term assets, which is purely the aggregate bond index and our income gap earning 4.25 cash equivalent. So starting off with 2000 to 2002, we have 3 down years in a row. We're taking income strictly from our income gap assets. In the third year, to replenish our bucket here, we are adding monies in from our short-term assets. And if you look from 2000 to 2005, only one time are we filtering gains from the growth assets to the income gap. But starting on 2006 to the remainder of the portfolio, more times than not, we're locking in our gains, we're filtering that down to our income gap or to our short-term assets to fill in that bucket. And as you can see over on the right-hand side, there is a significant delta pulling just from a 60/40 portfolio where you are locking in those losses versus only taking income from an asset whose only purpose is to take income from it, and other assets are generating gains for the portfolio. This is the strategic portfolio approach and why you can take more income than just 4% or whatever a 60/40 model says that you can take. Now, portfolio structure is only half of the equation. The next step, and what we'll cover in our next episode, is the actual system for adjusting withdrawals based off of portfolio performance. And that's what we're going to dive into next. How a dynamic withdrawal system can increase your income without increasing your overall risk. Thanks for tuning in to Summit Ascent Retirement. If you're enjoying this series, hit subscribe so you don't miss the next episode, where everything we've talked about today comes together to increase your income, create more meaningful memories, and to live your legacy. Until next time, we'll see ya.